Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in a half hour's time. Let's get to the stories we are following in the BNN Bloomberg newsroom. The Prime Minister, Mark Carney, says Canada and China are entering a new era of relations. The Chinese Premier Li Jiang says Beijing is willing to deepen ties with Ottawa in clean energy, digital technology, and agriculture. Both leaders have signed cooperation documents which center around trade, energy, construction, and public security. Jiang says Carney's meeting with the President, Xi Jinping, Friday, will pave the way for growth. Home sales declined across Canada at the end of last year, despite the lower interest rates. The Canadian Real Estate Association says the number of homes changing hands fell 2.7% in December compared to the month before. The benchmark home price also saw a dip to below $700,000. The housing market was largely impacted by economic uncertainty. Shares of Cogeco Communications rallying today. The company reported higher profit for its most recent quarter that did come in above estimates. Cogeco says despite a challenging radio market, revenue also increased, driven by robust growth in digital advertising. The company has reaffirmed its 2026 outlook. Bombardier, one of the best performing stocks in Toronto today. The plane maker expanding its operations in Quebec with a $100 million project. It will open a manufacturing center near Montreal to be completed by 2027. It will support existing facilities and increase production as well. A look at where we stand right now in the markets. The TSX Composite had an intraday high that pushed it above 33,000, but it's dropped down now to just under that, 32,974, a move up of 58 points. Let's go south of the border. The S&P 500 up just shy of 15 points right now. The Dow Jones, a 274-point move up, over 0.5%. And the NASDAQ, a 53-point gain, a 0.2%. The TSX crossed the 33,000 mark today for the first time, and it seems to be hanging in around that right now. Let's dig into where those gains have been coming from and what the forecast looks like for the year. We'll get that from Sébastien McMahon, portfolio manager at IA Global Asset Management. Thanks for joining us today.
Hey, good afternoon, Marilla.
So we're barely into the year. It feels like a lifetime already, so much going on. The TSX outperforming last year, and I'm wondering if you think it will again this year.
Yeah, we still think it's due to outperform, but maybe not as much as last year when we had 30% versus 15% in the U.S. When we started 2025, valuations on the TSX were pretty low, so the forward price earning multiples were low. Now they're somewhat elevated, so it's not going to be coming from multiples expansion. But when you look at what's expected for earnings growth for the broad market in 2026, you see 25% for Canada, about 20% in Europe and in the U.S. Likely this is too high a bar. Likely there's too much optimism out there, but it's still a low bar for strong performance. So we're still thinking maybe somewhere 10-15% for the TSX, somewhere around 10% for the S&P 500 looks right for 2026.
Okay, you see strength in commodities based on what?
Yeah, commodities are leading indicator, which is the global monetary policy cycle. So we look at what central banks are doing around the world, and we've seen lots of synchronized cutting over the last year and a half. So that points towards very good things for the global economic cycle in 2026. So we think an acceleration and not an exhaustion of the global economic cycle. So that should help commodity prices. And also in the U.S., we still have very expensive policy out there on the fiscal side, more Fed rate cuts to come. Defense spending, if any country out there didn't get the memo that it's time to invest importantly in defense, of course, they're getting it now. So that all of that means that commodities should be bid. And of course, with the world needs Canada sell, so that should also help with the call on the TSX.
Okay, you favor global investments over the U.S. as well. Why is that?
Yeah, we think that global diversification is key, especially with all of this geopolitical volatility coming from the U.S. I think you want to have a broadly diversified global portfolio. So the playbook here is a broad global diversification. You want real assets, and likely you want also precious metals for protection. So gold had a very solid year in 2025. It's looking like it's going to be having another good year, not exceptional like 2025, but should still have a good year based on geopolitical risk premium. And also the gold miners that we have in Canada, profitability should continue to be a very solid highlight in 2026. So even though we had more than 150% last year on gold miners, we're still bullish there. We are a bit more careful about duration, long duration, all of this spending that's coming on defense that's going to be coming through debt, of course. So at some point, the bond market could react negatively to all of that, but use volatility as a tool in 2026, not only as a threat. So call options, put options are going to come in handy. So it's a year to be flexible, not yet defensive, I would say.
Okay, so you mentioned some of the uncertainty that could be ahead. A lot of the uncertainty last year came from the tariffs going on, going off, being changed constantly. What do you expect on the trade front this year? What's your trade outlook, and how are you pivoting as a result of that one?
Yeah, we still think that global trade should endure through all of that noise, but we're going to have a lot of noise. So USMCA, we do think it's at risk of even maybe dying in the first half of 2026, because if you're Donald Trump, I think you prefer bilateral deals to trilateral deals because you have more leverage as, the largest economy in the world. So likely it's going to get worse before it gets better, but we do still expect that there's going to be a trade agreement that's going to be negotiated between Canada and the U.S. that could be signed by the end of the year, because Canadian and U.S. businesses need this free trade agreement in North America. So likely we'll have to make a few concessions, more likely on the supply management side. But I would not be surprised if at the end of the year we're talking here and we have a new trade deal that has a very different name, but still looks pretty much like the old trade deal that we had with USMCA.
Okay, so you think it'll be more bilateral than it will be a free trade agreement across the U.S. and Mexico included. Let's talk about AI for a moment, which seemed to run out of some steam at the end of last year. Are you pivoting in AI? Are you looking at energy, as many people are?
Yeah, we're looking at energy for multiple reasons, but I think the AI reason to look at energy is very solid. So one of the top picks of our equity team right now is Capital Power Corp. They're a company based in Edmonton that we like quite a bit. They trade like a utility, but they're a power producer. They're perfectly positioned for the AI-driven energy boom because they're investing a lot on flexible natural gas assets, and this is exactly what is needed as demand surges right now for those data centers. Companies start getting double-digit cash flow growth. They offer a very solid 4.5% dividend, so that's why they trade like a utility. And our analysts see roughly 25 to 30% upside over the next year. So we think it's a reliable growth plus income kind of play. So it's still an AI play, but now we're pivoting more towards the energy component of that AI theme.
Okay, so you've pivoted that way. Are you staying in AI stocks in the traditional sense, or are you sort of trimming out of those? Are you moving that money?
No, we're still staying in that team. When I was talking with my colleagues over the last few weeks, they are still thinking that we could have another moment in the semiconductor space and NVIDIAs of this world. So we'll see what we get, but maybe we're going to get into like that 1999 territory when there's an explosion in prices for those, because the rental price of semiconductors is still rising, so there's still scarcity in computing power out there. Capacity is not built up yet. So that could be another tailwind, a very important tailwind for semiconductors this year. So we're still watching that space.
All right, Sébastien McMahon, thanks for joining us. Appreciate your time today.
Always a pleasure. Thank you.
Coming up next, resetting the China relationship. Back in a moment. Chinese imports of Canadian goods dropped by 10% last year, likely because of the tariffs imposed on canola and seafood, with the prime ministers in China trying to reset that relationship. Jacques Choros joins us now, government affairs and trade specialist at Gowling, to talk about this. Thanks for your time.
Thank you very much, Morella. Good to be with you.
So memorandums of understanding have been signed. Are they binding in any way, or are they just a show of willingness to work together?
Well, I mean, it's a really good start of working together, demonstrating the importance of recalibrating the relationship between Canada and China. We've obviously had some very difficult moments over the last 5-6 years. This is the first visit of a prime minister to Beijing, an official visit, in the last 9 or 10. So without a doubt, this is a really good start. I think it's extremely important, but we obviously are in a moment where we have to be very careful. Our prime minister recognizes, I think, that there are landmines, there are effectively pitfalls and other things to watch out for. But we've got to be very careful and realize that these are initial first steps. While we do this, I think it's extremely important also with our second most important trading partner, which is China. Nowhere near the amount of trade that goes on, though, with the United States, probably 1/10 of it. But at the end of the day, we're dealing with a trading partner an ocean away, and we recognize the importance of our southern neighbor just, steps away. And sure, the Americans are watching what it is that we're doing. So we're very careful while we diversify our trade, while we recognize in the next 10 years, we really want to at least double our trade elsewhere. So how can we also show the Americans that what we're doing is going to be valuable for them? There are ways of us being able to do that. And I think those are the maneuvers that are needed to take place at this moment.
Okay, so we'll talk about that in a moment. On the energy file, which is a big one for Canada and China, China already buys some Canadian oil, some Canadian natural gas, but without more infrastructure, they really can't access any more, or can they?
Excellent point. No, well, we have to work on that. And I think that's where Canada is also looking for, I think, an investment from China in being able to do that, both with respect to being able to, provide oil, liquefied natural gas, working together in ways that provide the ability of China being able to access oil, which we definitely want to send. So that is a very important point. How can we also look to an investment from China that is not going to affect our sovereignty, not going to bind us in any negative ways? Let's go back to what was the theme very much of this government, which was evoked during the speech from the throne. The true north, strong and free, and it's how we actually address that. You have to remember, China wants, I think, to have a good relationship with us. They have recently met with the leaders of Ireland. They met with other leaders, Australia, I believe, as well. And so for them, it's extremely important for them, I think, to also realize that in the nature of the sensitivities and the kind of frictions that we're seeing come in the United States, there is an opportunity, but I think we have to be very mindful of how we actually do this. France and Germany are probably watching us closely as well, as they're the leader. Their leaders were also looking at, I think, improving the relationship with China. And it's interesting that China's president right now, Xi Jinping, is actually taking that step, and we'll be meeting with our prime minister tomorrow. So these are first steps. That MOU you mentioned right at the very beginning are sort of effectively the first steps in dealing with a crescendo, if I could call it that we would see coming out of this tomorrow.
Okay, let's talk about tariffs for a moment, which have to do with Chinese electric vehicles, which they would like to see pulled back. It's 100% markup for them to come into Canada. Can you see Ottawa moving at all on this, considering auto manufacturing being down in this country?
What a great question, Ron. I think that's what we're all wondering whether that's possible. I think it'll be very tough. Although, there were remarks that came yesterday from the president indicating that they do not want or they do not need an auto manufacturing activity in Canada. I think that it's a sensitive moment as to how we work through that. I think that there would be some difficult times in being able to actually address. I mean, we have 100% tariff right now on those vehicles. Chinese definitely want to sell them. So I think that is going to be a bit of a litmus test as to how we go forward. There are many Canadians that would like to see those Chinese vehicles here for a cheaper price, but at the same time, that could have a very negative effect on our industry. And that's something that really needs to be focused upon. And that's why you have effectively 5 ministers, in fact, on this trade mission, along with the Prime Minister. So this is something that Minister Joly will be looking at closely. Mr. Sadhu, international trade. They're there. I think they're doing well for us, I have to say.
Okay.
They're trying.
You mentioned that other countries are going to watch this closely, the U.S., of course, being one, and that at this point we need to perhaps make some sort of reach out or offering to the U.S. What does that look like?
Well, I think that we can. Look, I say this over and over again. While we're really looking at how we engage in this relationship with China, we can also demonstrate to our American allies, our friends, our neighbors, a greatest trading partner, there is value in us having a good relationship with China as well. It's to their advantage for them to have an ally like Canada, a friend is Canada, being able to, sometimes test the waters, address certain things together, recognize though that there are security issues. I mean, clearly, if what is motivating right now President Trump in looking to Greenland because he has concern of what China could do in the north, aside from what Russia might do, but what China, I mean, wouldn't it be better if we are able to really bring down the level of heat, the tension, and be able to actually engage meaningfully, being mindful, being careful. But I think that's where the value is. We have to remember in 1970, it was Pierre Trudeau that opened the door. A diplomatic relationship began in 1970. It's a long time ago, in a sense, with China. And then the Americans followed suit. And that was not something that was, I think, just happenstance. It was something that President Nixon recognized the value of that. I think there are ways of us being able to cooperate in such a meaningful way today in the midst of these challenging moments.
All right. Jacques Shore, I do have to leave it there. Thanks for the conversation. Appreciate it.
Brian, thank you very much. Pleasure to be with you.
Coming up, Taiwan Semi announced record-breaking fourth quarter profits today, reigniting interest in AI, at least for the day. We're back in a moment. Taiwan Semi announced record-breaking fourth quarter profits, up over 30%. The record high igniting interest in not just that company, but the AI industry overall. For more, we were joined by Matt Bryson, Managing Director of Semiconductor and Hardware Research at Wedbush Securities.
AI and accelerators for data centers has been what's been driving the TSM sales growth, and it looks like the same thing happened in Q4. And not only did AI drive stronger growth in Q4, but it also looks like that's going to be the case through 2026.
And they want to spend. They need to build. They're going to build out more, aren't they?
Yeah, they have to. They are the sole provider of high-end chips, and their customers are seeing incredible demand. And so TSM is spending to support those customers.
Now, can that be almost too much of a good thing? Can they meet that demand with the plans that you're seeing for them, where they plan to go this year?
I think there are bottlenecks across the supply chain. I don't think it's so much Taiwan Semi. So we're seeing shortages of memory in particular. So both the DRAM and NAND are constraints on system builds. Over in Taiwan, you're seeing something called T-glass, which is short, which prevents the manufacture of the substrates that these chips are manufactured with. So there are lots of constraints. I think at the end of the day, it's not going to be TSM's capability of manufacturing that holds people back.
But if there's nowhere to go if the other delays, could that have an impact on them, though?
They said that they don't think those bottlenecks will impact their business. But I think if there are bottlenecks, it will be those other products. Now, having said that, what we see when products are in short supply is you see a shift towards the higher value chips, if you will. And so from a Taiwan Semi perspective, they probably capture more and more of the value because, again, they are producing the most advanced semiconductors on the planet.
Yeah, and one part of their expansion, I guess, is they're looking at the U.S. Is that political or is that actually good for business?
I think it's a little bit of both. So certainly customers away from the U.S. desire for manufacture, they want to diversify risk in a world where there's clearly geopolitical tension between China and the U.S. U.S. manufacturing allows TSM to meet that demand from their customers. But at the same time, I don't think it's a bad thing to go and build out a ton of factories in the U.S. when you have a president who very much wants to see companies supporting U.S. manufacturing.
And it brings a lot of it closer to home. With everything that's going on, we've heard talk of bubble, frothy. What does this tell you about the tech sector and AI?
I mean, I think it tells you what at least I've been running into over the last 3 to 6 months, which is if there is any froth, if there is a spending bubble, we're not going to see that froth come to an end in 2026. You're not going to see that spending bubble pop in 2026. I think throughout the story of AI since ChatGPT 4 launched, the reality has been we've only been able to see about 12 months out. And there's always been concern that, yes, we can see the next 12 months. It's what comes beyond that. I think we're still, to some extent, in that reality. Having said that, what we can see looks really, really healthy.
All right. Is it a potential headwind for TSMC with the big tech companies talking about making their own chips? Is that realistic?
So, I mean, Google definitely is having success with their custom ASICs. With TSM, you know, the great thing about TSM is it's not like you have to debate between should I own Google or Broadcom because they're manufacturing Google's TPUs, or should I own NVIDIA because you look at all the major suppliers out there. NVIDIA uses TSM, AMD uses TSM, Broadcom uses TSM. So Marvell uses TSM. So by proxy, Google and Meta and Amazon and Microsoft, who all have their own chip ambitions, they are all fabbing through TSM. And so TSM wins no matter what direction people go in.
Matt Bryson, their managing director of semiconductor and hardware research at Wedbush Securities. A last look at the North American markets ahead of the end of the trading day. And it looks like the TSX, if it holds, could have another record close above 33,000. Is at 33,009. We will watch that. The closing numbers coming up next. Stay tuned for that. Here are the closing bells for the end of the trading day. At the Nasdaq, American Drive Acquisition Company ringing the bell. Carlyle Company celebrating its 65th anniversary of its listing in New York. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. And the TSX holding on to a gain made today of 112 points to close for another record high, 33,028. So the first close above 33,000 today. So it's 0.3 of 1% a move for the TSX. Let's get to the S&P. It gained just shy of 18 points today, about 0.25%. And the Nasdaq had a 58-point move up to 23,530, about 0.25% as well. Let's get to the movers in Toronto. Bombardier gaining over 7% today, so that is a $17.82 move up, taking stock to $266.20. That is on an announcement they made today. Stephanie Hughes will have more on that in just a moment. Finning International up as well, over 5%. That is a gain of $4.29 to $83.31 a share. Brookfield Business Partners also a gainer today. It moved up 3.4%. Taking the share price to $50.27. And then Cogeco Communications reported earnings that did beat estimates, so they got a move up of 3.5%, or $2.45 a share, to $70.86. Okay, let's go to the flip side. Gold, a loser today for Alamos Gold. It's down 6% plus, or $3.70 for the loss, to $55.98. Aya Gold and Silver also dropping today, 5.5%, losing $1.33 a share, taking it to $22.85. And then TerraVest Industries, which does well processing, they moved down as well, 5.4%, taking the stock price to $163.29. All right, let's get to more on the movers with Bloomberg's equities reporter Stephanie Hughes. She joins us now. Stephanie, we talked a bit about Bombardier gaining quite a bit today on news of a new plant. Fill us in.
Yeah, that's right, Morella. So Bombardier shares gained by over 7% at their highest point, which brought the stock price to its highest level since 2002. That's when it was caught up in the wealth effect from the dot-com bubble, which ultimately ended up coming back down. But the private jet maker is gaining today based on this announcement that it would be investing $100 million Canadian to build a new manufacturing facility near Montreal to boost production capacity. So the company said that this is part of a strategy to meet the growing demand for business aircraft. It's a facility spanning 126,000 square feet that is set to open sometime next year. And so analysts also weighed in on this. RBC Capital Markets said that this is a positive for the company as it will position Bombardier to meet that high demand in a market that really hasn't produced much or had a lot of production since the pandemic. So a lot of that demand is coming from boosted spending in the defense segment. So it has some surveillance aircraft there and just some wealthy individuals, not me, who have more money to throw around at private jets. So things like that will always keep Bombardier in business, Morella.
Okay, let's get to the next story. Sell America trade of 2025 seems sort of alive and well in 2026. What are you seeing?
Yeah, that's right. So I was working on a story about how Canada can actually benefit from these Sell America trades. So Canadian stocks were able to notch their best outperformance over the U.S. in 2 decades. And some money managers I've spoken to expect that to continue into 2026 as traders are flocking to gold assets. So coming off a year where the TSX's 2025 gain of 28% far outpaced the S&P 500, we're seeing that momentum carry over into the new year with Canadian stocks still outperforming the U.S. In fact, just as you mentioned in the movers segment before we started talking, the TSX actually managed to top the 33,000 point milestone for the first time ever. So we're just 2 weeks into the year and we're already being bombarded by headlines like the abrupt ouster of a Venezuelan president and the U.S. administration's Justice Department attacking the Federal Reserve. That's already sending traders to safe haven assets to start the year. So market strategists are saying that this is reigniting a Sell America trade that's putting some fund flows into other international markets outside of the U.S. And that's where Canada steps in and is poised to benefit from that mentality as well as just gains in gold and silver in general, Morella.
Okay, so I know you've been talking to portfolio managers a little bit more about how they are putting this into action, the Sell America trade. What are you hearing from them?
Yeah, that's right. It's interesting. So they're either have already hedged or are about to hedge some U.S. asset weakness. I spoke with Laura Lau from Brompton Funds, also a regular on BNN, and she said that she's really liking Canadian gold miners like Agnico Eagle and European defense names like Ryan Mittal. Also spoke with Brian Madden from First Avenue, who said that the loonie is undervalued against the U.S. dollar. And since, in his words, the U.S. administration seems hell-bent on undermining the central bank, then the case of hedging U.S. dollar exposure is that much stronger. So, of course, not everybody's pulling a lot of money managers are still bullish on the U.S. Nobody's pulling all of their positions out of that market. But they are, most of the money, even though there are some concerns around AI overvaluation, the U.S. is just too big to ignore. But Canada is emerging as an opportunity for a lot of traders, and you can see that with the gains TSX has already enjoyed and just the outperformance gap it's had over the S&P 500 in the past year and already in the first few weeks of the trading year this year, Morella.
Yeah, so many record closes already. A storyline we will watch. Bloomberg, Stephanie Hughes, thanks for that. All right, let's go to south of the border. Bloomberg's Michael Regan is the managing editor for U.S. equities team, and he joins us to talk. Michael, KLA Core, they make semiconductors, are up today, so are others in the space. What happened here?
Yeah, really bullish day, Morella, for the whole semiconductor industry. I think it all started off with Taiwan Semiconductors' outlook for capital spending for the year being much stronger than many people thought, really kind of boosting confidence that this AI story for the chip makers will continue for another year. And then there was a flurry of very bullish notes from analysts. KLA, especially up about 7, almost 8%. They were upgraded to overweight from equal weight at Morgan Stanley. They cited the semiconductor equipment makers' exposure to memory chips, saying memory has emerged as a key AI bottleneck, and KLA's memory story remains underappreciated. Really big boost to their price target, too, up more than $480 to $1,697. Lam Research also had their price target raised by the same analysts. And both KLA and Lam, as well as Broadcom and Analog Devices, were also upgraded at Wells Fargo Securities. So really strong day for chip stocks all around with this flurry of news.
Okay, let's get to Morgan Stanley gaining on an earnings report. A lot of the financials reporting this week.
Yeah, and it had been a pretty much a downer of a story for most of the big banks that reported, but Morgan Stanley, Goldman Sachs bucking the trend today. Morgan Stanley beat estimates. Really, the standout was their debt underwriting bankers. They increased revenue by 93% in the fourth quarter, by far the biggest jump on Wall Street and capping a record year for that business. They're especially active in that AI data center space, including a more than $27 billion debt deal involving Meta Platforms there. And it brought their investment banking fees to $2.41 billion, which is up 47% from a year ago. So the bank earnings season really taking a turn for the more positive after some negative news and negative price action, at least earlier in the week, Marilla.
Okay, let's get to Coinbase because we are seeing crypto down. That was because of a delay in the Senate. Can you explain what happened?
Yeah, Coinbase down. A lot of crypto-exposed stocks like Robinhood also down. Bitcoin itself down quite a bit. And this is after the digital asset bill basically paused in the Senate, in large part perhaps because of Coinbase's own opposition to the bill as it's currently written. And a big sticking point is stablecoins, those dollar tracking or other currency tracking cryptocurrencies. The bill as it stands does not allow crypto companies to pay yield on those stable coins. That's something a lot of people in the industry wish they could change in this bill. And Coinbase being among the more vocal opponents to this bill. So it's back to the drawing board for this digital asset legislation in the Senate. And at least for today, the whole crypto industry not taking it very well, Marilla.
All right, Michael Regan, appreciate the update. Thank you. Up next, U.S. markets returning to the green today. We'll take a bigger look at what took them there when we come back. North American markets moving higher today, recovering in the U.S., at least from some early week volatility. Gains led by companies in banking and AI. Let's go to Amanda Agati. She's Chief Investment Officer at PNC Asset Management Group to talk about what is ahead for the markets this year. Thanks for joining us today.
Thanks so much for having me.
Can we start with what you refer to as the wild card of geopolitics? Do you expect sustained market reaction to some of what has unfolded so far?
Well, I don't know that the market is particularly focused on the things that have happened just recently, but we do think that the purple haze, as I've been describing it, of policy uncertainty, geopolitical tensions, and sort of hotspots around the globe, certainly being a piece of that. I think the market's going to be more focused on it this year than it was last year. But usually markets are only, materially concerned, aka, leading to a market market correction of sorts, when we start to see energy policy being materially impacted or some sort of disruption to oil production or oil supply. So to the extent we stay away from that edge or that brink, if you were, I think the market can kind of move past some of the geopolitical noise. But I do think that fiscal policy, Fed policy, we have a midterm election cycle here in the U.S. Those things are going to be important drivers for the market in 26.
Okay, let's talk about your outlook, if you don't mind, for the American economy for the year, given the softness in labor and knowing that the Federal Reserve has been very focused on that.
Yeah, we actually think it's going to be a pretty solid 2026. Our expectation for U.S. real GDP growth is to about 2%. I think that's on the lower side. I think there is the potential for an upside surprise and an acceleration. We're going to finish 2025 in a very strong place. Q4 expectations for growth have a 5 handle on them. So if that comes to fruition, it's going to be about 3.5 or close to 3.5% growth for 2025. So I do think that there is some upside to growth. We have a lot of momentum starting off 2026. And some of the fiscal policy actions that were taken over the course of 25, I do think will come home to roost in a positive way to help reaccelerate growth. So we're feeling pretty solid in terms of the backdrop as we start out the new year here and as we kind of see 2026 playing out. It's just that wild card is a lot of policy uncertainty and policy noise.
2025, as you know, very much an AI-driven market, but then it tapered off at the end of the year, lost some steam. Will it be less of a driver, you think, in 2026?
I think it's still going to be a pretty big driver. It's hard to bet against the AI trade in this environment. I think more what was going on into the end of last year was really a question around valuation multiples, right? A lot of talk about bubbles, frothiness, et cetera. We don't think that we're, faced with a bubble scenario in all things AI, but valuation multiples are pretty extended. And so we're starting off this new year here with pretty extended valuation multiples. It didn't give us much of a reset. So I do think the AI story is going to continue to be important. I think from a market leadership standpoint, it's critically important. But what's interesting about 26 versus 25 is the distinction between earnings growth for the S&P 500 with and without the top 7 or 10 names narrows quite a bit. It's only about 200 basis points difference. So I think that speaks to signs of life in the broader 490 stocks in the S&P 500.
Yeah, some of that still might be AI driven, right? With the play out from AI, specific stocks to the energy sector, that kind of thing. How are you playing that?
Well, so we're very positive on AI and the AI supply chain. So back in the fall, we did tactically lean into greater and more targeted AI exposure through the use of an ETF strategy and also an international exposure. So we do think the AI and technology story does go beyond U.S. or domestic companies. And so we're leaning kind of with a barbell approach between U.S. and also emerging markets and China more specifically. I think there's a lot of opportunity. We think it's very early innings, maybe 3 or 4 in terms of that inning. And so a lot of runway left. I think the key, you called it out, what happens with power, energy, et cetera, supplying it, data centers too, but there has to be more to it than just the infrastructure build. And so I think the use case story, the new business models for 2026 are going to be really important and interesting in terms of the continuation of the rally.
You refer to the midterm elections, which happen at the end of the year. What is the typical market response to these votes?
The market loves a gridlock scenario. The market would be betting, if we had the midterm elections right now, the market would be betting for change of control, some seats lost in the House, and certainly the House flipping to the Democrats. But I sort of giggle a little bit and joke that, the market likes gridlock because it doesn't really want Washington to do a whole lot. And so when you have divided control, it tends to limit policy surprises in one direction or another. So usually under a divided government scenario, scenario, we tend to see the best performing market environments. And, again, we'll see. There's a lot that can happen between now and November, but I think that's the scenario that the market would be happiest about.
There's a lot that can happen considering what a bumpy start to the year we've already had. It's only been a couple of weeks. All right, Amanda Gatti, thanks for joining us. Appreciate your time. Coming up, shares of Cogeco getting a lift today after the company's profit beat expectations. More in a moment. Shares of Cogeco are trading today 3.5% higher after the company reported profit that did exceed expectations. Our next guest says the company continues to trade at a large discount to both Canadian and American peers. Let's go to Vince Valentini, Managing Director, Equity Research, TD Cowen. Thanks for joining us today.
Thanks for having me.
So, Vince, numbers are down year over year, but still considered a beat. So can you give us a wider look as to what has been dragging this company down?
Sure thing. Yeah, the expectations were pretty low, so the beat was off a low base. They've been having some real troubles in their U.S. cable segment. The main portion of this business is their core Canadian business, which they've been running for 40 years. But over the last decade, they've expanded into the U.S. cable market, and that market has gotten really competitive in the last 2 or 3 years. Fixed wireless competitors like T-Mobile, new people building fiber to compete with cable companies. So they have been losing internet subscribers at a pretty rapid pace over the past 5 or 6 quarters. And that had scared people, and that's flowing through their revenue and EBITDA that we're still seeing them report today. But the shining light today was their internet subscribers in the US market were down much less than people expected, only down 1,000, where most people were expecting 6,000 or 7,000 losses. That's the best quarter they've put up in 15 quarters in that U.S. business. So some signs of stabilization, better marketing execution by the Cogeco team in that challenged U.S. market. But the key thing that's driving the financials is still their Canadian business.
Okay, so have they focused more on Breezeline, I guess is their brand in the U.S. Have they been focused more on American operations and trying to steady that?
Yes, absolutely. The new CEO came in just over 2 years ago. He's in the midst of a 3-year action plan to address the cost side of the equation. If they don't have much revenue growth in the U.S., they want to make sure the cost structure is aligned with that, so the cash flow generation is still strong. And also has rejuvenated some of their marketing strategies. He's using new digital sales tactics. They're launching a new digital brand in February in the U.S. market, similar to the Oxio digital brand that they would have in Canada. That's been quite successful. And just better sort of call center and marketing activities using data analytics and new technology to the best extent they can to try to make sure they get at least their fair share of the internet subscribers in a competitive market. And this quarter is the first time we've seen some good evidence that those efforts are gaining traction.
Is Cogeco seeing any growth in Canada?
Yeah, absolutely. They've actually been the best performing Canadian cable company if you just look at core sort of subscriber metrics. Their internet subscribers are up 5% over the last 12 months in Canada, which is a combination of doing okay in their legacy core territories like Oakville and Burlington, but also they've expanded into rural areas with government subsidy help, and they're having a lot of success growing subscribers there. Plus that Oxio digital brand that I mentioned before that gives them a two-pronged attack in the market. Cogeco and Oxio are sort of different brands with different price points. So yeah, no, in Canada they're seeing decent internet subscriber growth. Their EBITDA, I mean, this is not a fast growth business. No telco is putting up huge amounts of growth. People don't own telcos or cable companies for growth. They own them for cash flow and dividends and defense. But still, they put up 2% EBITDA growth year over year in their Canadian business this quarter, which people view as quite respectable.
Okay, you're thinking that they're going to have about $200 million in share buybacks this year. Why is that?
Yeah, so this is the key as to why I still like this stock, and we took our target price up to $100 today, is I think people are missing that even though there's not much growth here, the valuation is at rock bottom levels. This is one of the 5 highest free cash flow yielding names in the entire TSX, not just the telecom sector, which means it's one of the 5 cheapest names on a free cash flow basis. When you're generating that much free cash flow, which is very stable and predictable, people need their internet connections, and there may be a little bit of negative growth, but for the most part, their business is stable. They can use that cash flow as a as a weapon almost when their share price is this cheap. The free cash flow yield up near 20% means they can be very accretive and opportunistic in buying back shares. They've just come through a period of paying down debt. They got both S&P and Moody's to improve their credit ratings over the past couple of months, which I think will free them up to start buying back shares, which they haven't done for a couple of years. Management seems to be signaling they won't start this next week or next month, but I think as we move into the next fiscal year that starts in September, we'll start to see them buy back shares. And if they can buy back 200 million shares, that's a material buyback that is going to be materially accretive to EPS and free cash flow per share that I don't think the market has priced that into the stock yet.
I was going to say, why do you think Cogeco gets overlooked if it is in that situation where it's going to buy back and, as you say, the valuation is quite low?
It gets overlooked for two reasons. One, it's just smaller and doesn't have all of the asset classes that we think of a traditional telco, most notably wireless. So the big guys like Bell and Telus and Rogers are all integrated fixed line and wireless players, much bigger market caps, much more liquid names. So Cogeco is a little bit of an afterthought from a business and scale perspective. There's also a bit of a taint on the name, to be quite honest, of historic actions that the board and sort of ownership have taken. If you recall back in 2020, takeover offer from Rogers and Altice at $150 a share. The stock price is now sitting around 70, and some people have long memories to say, hey, if you weren't willing to consider shareholder-friendly alternatives like that takeover offer at that time, we're a little bit gun shy to come back to the name. So there's two kind of reasons it's in the penalty box, but I acknowledge those headwinds, but I still think the stock is too inexpensive now and has good room to rally.
And it does pay a decent dividend, 5.5%.
Look. I think that gets very overlooked. The stock has a higher dividend yield than BCE, 5.6%. BCE's at 5.2%, but Cogeco is growing their dividend. Like, we should see at least 7% dividend growth consistently, maybe even higher than that. And their payout ratio is extremely low, below 40% of free cash flow that they're paying out. So it is a better quality dividend name than some of the bigger cap telcos, and given how cheap the share price is, it actually has a higher yield than BCE right now. So yeah, it's an attractive dividend name for investors who are looking for that in their portfolio.
Vince Valentini, good for you to join us, sir. Thank you.
Thank you.
A reminder, of course, BCE is a parent company of this channel under the Bell Media brand. Coming up, the Canadian auto sector getting squeezed with talks in China about tariffs on EV, and of course, talks from the American president saying that the trade agreement in North America is irrelevant. More in a moment. Here are the stories we are following in the newsroom today. The Prime Minister says Canada and China are entering a new era of relations. Chinese Premier Li Jingyang says Beijing is willing to deepen ties with Ottawa in clean energy, digital technology, and agriculture. Both leaders have signed cooperation documents which center around trade, energy, construction, and public security. Jiang says Carney's meeting with the President Xi Jinping on Friday will pave the way for growth. Home sales declined across Canada at the end of last year, despite lower interest rates. The Canadian Real Estate Association says the number of homes changing hands fell 2.7% in December from the month before. The benchmark home price also saw a dip to below $700,000. The housing market was largely impacted by economic uncertainty. Goldman Sachs broke an all-time Wall Street record after posting equities trading revenue that surpassed $4.3 billion for its fourth quarter. Revenue in its global banking and market division also hit a record for the full year. Goldman Sachs boosted targets for its asset and wealth management unit and also raised its dividend. And then Morgan Stanley capped off a record-breaking year with a more than 90% increase in fourth quarter revenue from its debt underwriting. Total revenue and profit also came in above Wall Street estimates, and new assets in its wealth unit surpassed expectations. The bank says results were boosted by a rise in fees for advising on mergers and acquisitions. Canada's auto industry is in a difficult position, under pressure from the U.S. and under threat from China. Let's go to Brian Kingston on this, President CEO of the Canadian Vehicle Manufacturers Association. Brian, thanks for joining us today.
Thanks for having me.
Recently, the Ontario Premier said that seemed to support bringing Chinese EV manufacturing to Canada, Ontario specifically. Do you think that'd be a positive for the sector here?
No, I don't. And frankly, I don't think it's ever likely to happen. The Chinese model is really based off building vehicles with lower environmental and labor standards in China, which then allows them to dump those vehicles into markets around the world. Setting up a plant here in Ontario, for example, where you would have to pay union wages and comply with very stringent regulations doesn't really jive with the way that they've built out their model. So I don't think it's realistic. And frankly, the economic benefits just aren't there. If you look at what Ford, General Motors, and Stellantis do when they build a plant, they have this massive supply base all around their plant, and that creates jobs in the community they're located. Most Chinese factories use what are called knockdown kits, where they effectively just send all of the parts and components from China to the plant, throw them together, and then the vehicle's finished. So it doesn't have the same economic spin-offs that you would have with a traditional manufacturer. So a number of reasons why I don't think it's realistic.
On the broader storyline of EVs, I'm just wondering, we are seeing consumers sort of lose incentives and so lose interest in buying EVs. Would opening up the market even make sense? Or do you think any hit from a flood of EVs from another country could be contained because consumer interest isn't there?
No, I mean, look, we survey Canadians regularly about their interests in EVs and what the barriers are. And, what we find is consistently challenges around charging infrastructure and battery range. And so both of those issues won't be addressed by having a Chinese EV in the market, for example. We have really failed when it comes to building infrastructure across this country at the rates required. The federal government was calling for 100,000 public chargers in 2025. And we're sitting at around 30,000 chargers. So huge gaps in what was needed to support this transition. And as a result, consumers are saying, I'm going to wait. Maybe I'll move to a hybrid or a plug-in hybrid, see how things evolve before I make the jump into full EV. So I know one thing, China is not the solution to boosting EV adoption. We've got to work on all those preconditions to help mass market adoption take place.
Okay, let's turn our attention to the North American process. You heard the U.S. president only this week on CUSMA being irrelevant. Does this talk concern you? Do you chalk it up as rhetoric at this point?
I'm not concerned. I'm going to remain the ultimate optimist here for CUSMA and the North American trade relationship. Look, the president, he's a negotiator, and he says things like this. I thought what he said this week was really nothing new, not surprising. We are heading into a review of this trilateral trade deal. The U.S. business community is increasingly vocal about why we need this deal. We're seeing auto company CEOs out speaking about the importance of an integrated North American market. So I think we will get through it because it ultimately benefits America. Canada is the largest export destination for U.S. auto, and it's not even close. This is a very lucrative market, and if we want to continue to trade in a tariff-free environment, we need CUSMA. So I think it's going to be challenging. There's going to be lots of ups and downs, just like when we went through the renegotiation of NAFTA, but we will get there because not having an agreement would be so economically damaging to the Americans. You'd be talking about tens of thousands of Americans in the auto industry not having jobs because they wouldn't have vehicles to sell to Canada. So it wouldn't make sense. We will get a deal. Can
you give us an update on how the sector is doing? We know initially there were threats of tariffs, then there were carve-outs under CUSMA, but some Canadian-made, fully Canadian-made vehicles, for example, going into the U.S. would face a markup. So how is the sector doing with all of the turnaround it's had from last year?
Well, it's just incurring significant amounts of cost, and it's all because of erratic government trade policy. And just to give you a sense, the current estimate is that the auto industry will incur about $188 billion in tariff costs over the next 3 years because of the U.S. tariffs, and now, of course, other countries including Canada, have put in place retaliatory tariffs on American vehicles coming into Canada. So manufacturers are dealing with a high-cost environment, and ultimately it's eroding North America as a manufacturing jurisdiction. We're in this bizarre situation where it's now more cost-effective to build a car in Japan or in Europe and send it to the United States than it is to build in the US, because a company in the States has to pay tariff on all of their aluminum, all of the parts and component inputs that come into that vehicle. You're getting tariffed numerous times, which ultimately raises the price and is going to reduce consumer demand. So it's a high-cost environment, but it can't sustain. It's just simply too much for the industry to bear, and that's why I think we will return to a more normal trade balance stance.
Brian Kingston, thanks for joining us on The Close. Appreciate your time today.
Thank you.
Coming up next, the American president announced he's going to impose a 25% tariff on some semiconductors, including the chips, of course, NVIDIA and AMD will sell to China. More in a moment. Time now for hot picks and transportation. We're joined today by Ari Rosa, analyst at Citi, and we kick things off with an update on the possible merger between Union Pacific and Norfolk Southern.
They submitted a merger application to the Surface Transportation Board, the STB. They did that in late December. And so now the STB is in the process of reviewing that. There's a 30-day comment period. And so we're expecting that by January 18th, they should have comments back. And so that'll be interesting to see what kind of feedback they provide. Of course, a lot of the competing railroads have raised all sorts of complaints and concerns, saying there's insufficient disclosures, that it doesn't discuss enough how it could impact competition, that they haven't provided enough detail around their synergy targets and what kind of business growth they expect to achieve. But look, I mean, it's a 7,000-page application, so it's not exactly lacking in information. It's just a question of are they providing the right information, and will the STB find that credible? And that's a question that, frankly, is going to play out over the course of the year. And so as we think about, we just issued last week, we issued our 2026 outlook. One of our predictions, it's not really going out too much on a limb, but this discussion around Union Pacific and Norfolk Southern really will dominate headlines across our space, at least across the transportation landscape throughout the year.
But even if the merger is delayed or it doesn't even happen, you think Union Pacific looks like a decent stock right now?
Well, absolutely. So this is the reason really we like Union Pacific so much right now, is that it's kind of fallen into what we're calling deal purgatory, where the stock really hasn't done very much. You can see from that chart there. And yet the network is running phenomenally well. I mean, some people would say it's running the best that they've ever run in terms of network fluidity, efficiency metrics. And so they're doing a really nice job in terms of free cash flow generation. Their margins look solid. And so this is a business that, almost regardless of what the merger outcome ends up being, I think they're quite well positioned. And so relatively little downside and fairly attractive upside, which is kind of a setup that we tend to like. And then, of course, you have that extra kicker if you get the merger synergies that the company's been talking about. Now, in fairness, some of those won't materialize until 2028, 2029. But either way, Union Pacific looks like a stock that has relatively little downside risk and is just a very high quality business that continues to produce a lot of free cash flow.
Yeah, we're tight for time, and I'm sorry about that. United Parcel Service, UPS, despite competition that has pushed the PE multiple down, you see potential here.
Yeah, and so UPS pushes us a little further out on the risk spectrum, but UPS has a 6% dividend. So any of your retirees there, any of your long-term holders, I think they should be drawn to that. And frankly, look, we see the 6% dividend yield as too high. It should come down over time, and that, of course, should support the stock price. UPS was pretty explicit in coming out last quarter and saying, look, the dividend is safe. Our analysis suggests the balance sheet continues to be strong. And so it's a really nice dividend yield. It has some challenges. They're facing some questions around competition. But kind of at a fundamental basis, from a fundamental value basis, I think UPS looks attractive.
And then finally, a Canadian name. We're going to look at the New York listing, though, for a TFI International, a big trucking company.
Yeah, we really like the management at TFI. We have Mr. Alain Bedard, who's been a colorful character in the industry for years. But he's a really sharp operator and a really savvy business mind, where he focuses on the things that management teams, we wish more management teams would focus on those things, which is how do you drive shareholder returns? And so very focused on free cash flow, very focused on being opportunistic in terms of M&A opportunities. When everyone is down on the cycle, that's usually when he's most active. And so we think there's a lot of upside there, and particularly given some of the things that have been happening on the U.S. side, where trucking rates have started to pick up because of some of the government enforcement actions. We think TFI is well positioned to benefit from that because, of course, they have quite a lot of business both in the U.S. and in Canada.
That's interesting, yeah. And you say, I think you may have touched on this, but you say a good record of acquisitions. Absolutely, yes. And so they've been very acquisitive, and that in turn has driven up earnings per share over time. They're very savvy about M&A and doing it opportunistically to drive kind of accretive earnings growth.
The Trump White House announced that chips imported to the U.S. and not used domestically for AI and then exported to another country will face a 25% markup. Let's go to Jay Goldberg on this, senior analyst at Seaport Research Partners. Jay, thanks for joining us today.
Thanks for having me.
So it's not the 100% tariff threatened last year. Is this a bit of a relief for those who make these chips?
I think so. I think the entire industry, and probably all industries, appreciate some sort of stability around tariffs and some clarity on where that's going. And certainly this is good news today and helps the sector.
Okay. Does it happen a lot where countries bring chips into the U.S. only then to export them out?
Not really, not that often. Most of the time, things that American companies sell to other companies don't transship through the U.S. They're sort of things are shipped to China or Shenzhen or Taiwan and then shipped off to the third country. So we don't import that much except into finished goods that we use ourselves.
All right. So why approach it this way?
That is almost a political question that is beyond my pay grade. I think there's I think there is this idea that GPUs, that chips are a scarce commodity, and some people in the government feel like we have to protect those and make sure we have enough AI chips domestically. I don't think there's really a big risk of that, but I think that's where the sentiment is coming from.
Okay, so how will this work with the chips that are going from NVIDIA, for example, to China? If they're made in the U.S. and sent to China, they're already going to be marked up, we understand, by Washington. Washington wants its cut, but to apply under this tariff, they'd have to be made somewhere else, brought into the U.S., and then shipped to China.
Yeah, I don't think that happens that much. I think if you look at the news today in conjunction with the news a couple of days ago about the clarification of rules around what NVIDIA can ship to China, we see this recurring theme of the U.S. government wants to make sure that U.S. companies have more than enough silicon, more than enough chips, all the chips that they need for their ends before anyone else gets them. And I think the market was kind of taking care of that just fine, but the government is doing what the government does in the context of a broader trade war between the U.S. and China, and this is one more step in that direction, sort of cementing their position along those lines.
Okay, so we did see some earnings results from Taiwan Semiconductor. They did well. That moved a lot of the AI up today. NVIDIA did gain. You have a sell rating for NVIDIA right now, but a hold rating for AMD. But can you explain what difference you see between the two?
Sure. I think the big difference here is that NVIDIA's upside is largely priced in. This is the most scrutinized company in the planet. Everybody knows what their supply chain looks like. We know what their capacity is, how many chips they're going to get out of TSMC this year. They've said repeatedly that they're sold out. And once you're sold out, that doesn't leave much room for upside. There's a little bit here and there with how much can they ship to China? Can they squeeze out a little bit of extra capacity from TSMC? But beyond that, there's not much scope for upside. AMD, I'm a little more bullish on in the sense that most people have sort of assumed that they're not going to get very far in AI. They've made a lot of progress. I think now that we're kind of at the point where the stock is sort of priced that in. we'll see, I think in sort of 2 years down the road, AMD's products are going to be incredibly competitive with NVIDIA. It's just 2 years is a long time in stock market.
Absolutely. All right, Jay Goldberg, thanks for joining us. Appreciate your time.
Thank you.
Coming up next, Canadian residential real estate declining last year. We have some numbers from the end of the year. We're back in a moment. The residential real estate market ended the year with a whimper, but our next guest says we could face a more stable year this year. Let's go to Ross McCready, Chairman and CEO of Sutton Place. Ross, thanks for joining us today.
Thanks for having me.
What would you say was the biggest drag on the real estate market residentially last year? Was it just job fears?
I think overall, I mean, the numbers are interesting that we've stabilized as we have. And I was actually kind of surprised that we ended up being as flat as we have. And prices haven't decreased that much in reality, because real estate is perception, and the perception out there has been pretty negative. So I think on whole, I was a little bit surprised that we've stabilized the way we are.
Okay, so let's dig in a little bit more to what we saw all of last year. Were there trends that you noticed more regionally when you look at the numbers?
Yeah, and I think that's an important thing. So CREA's numbers are out, they're national numbers. I think in order to really understand the numbers in the real estate market, you have to go locally. And then when you go into even each local environment across Canada, then you have to go into specific product types. So a big bulk of the Canadian marketplace in terms of real estate is Ontario for the vast part, and then BC being kind of second. But a lot of the negative press that you've seen on that has been on the multifamily and has been on the investor product, which for the past 4 or 5 years, the Canadian government and the provincial governments have done a great job of getting rid of real estate investors.
Okay, so talk to me a little bit about the inventory that we've been seeing, because we know inventory was higher. Clearly, more people were willing to sell, but was it just the mix that wasn't right for people who want to get into the market? For example, were we seeing enough new development?
Yeah, and I think that's been the problem. A lot of times when people look at new development, it takes anywhere from 7 to sometimes 12 years in Ontario to develop a multifamily high-rise tower. And I don't think people fully understand that. And so a lot of the product that was designed and built over the past 5 to 7 years has been geared 70% of that towards investors. And so they're building smaller units. And that really doesn't address what a lot of Canadians want in terms of housing. So there's been this huge lag in terms of product offerings that Canadians actually want across Canada, including some of the urban centers as well.
Okay, because it's hard to pivot, right? You can't, once you start a development, you can start and stop, but you can't really pivot to something else.
Yeah, and I think the developers got kind of addicted to that model of being addicted to those investors and the way it's been worked out. I think, unfortunately, too, I think we've created our own problem, and the government, at the same time, by trying to focus on housing right now, I think the Canadian government needs to focus on our economy and the productivity of Canadian workers, which has dramatically decreased over the last decade.
Okay, so when you look at the year ahead, what is your expectation for the market?
I think the market's going to be relatively, on a national basis, I think you'll see it fairly flat. I think when you go regionally, I think Quebec and Montreal, in particular in Quebec City and places like that, are continue to be very strong. I think they're used to a lot of whiplash in terms of headlines. I think what people don't really fully understand in the Canadian marketplace, that we've had 20 plus years of almost nonstop capital appreciation related to real estate assets. And that's not normal when you go around the world, and I have worked around the world. So I think people's perception needs of the real estate values in your home are not going to necessarily go up each and every year. But more importantly, I think what Canadians need to start thinking about and advocating strongly with their local politicians and federal politicians and provincial is to figure out why, if we want to start building housing, what we need to focus on is jobs. The housing sector and developers across Canada are some of the best multifamily developers in the country, whether it's single family, like companies like Mattamy Homes in Ontario, which is a phenomenal single family and multifamily builder, including across the country. So the government needs to just build through the infrastructure, get rid of regulation, and make sure that we can be competitive and creating jobs for our Canadian economy.
Okay, when you look at rate cuts, which we did have last year, are you factoring in any sort of uptick from possible rate cuts this year, or do they not really count as much as they used to?
Yeah, I don't think it counts as much anymore. I think the last 2 years has been frightening for a lot of people because they got in at a relatively free money back in 2000, 2001, 2002. And so those people that had to refinance their mortgages in the last year and a half, and even this year, it's been problematic. But I can say at 4%, and we are down 2%, but at a 4% interest rate, that's relatively inexpensive. And again, when you go globally and you start thinking about what lending rates are, Canada remains one of the more lowest in the world. So I think 4% is a reasonable number for people to be thinking about going forward. So from that perspective, I don't think one way or the other is going to change the housing market or get first-time buyers into the market if we drop a percentage point.
Ross McCready, I'm going to leave it there, sir, but thanks for your time. Ross is Chairman, CEO of Sutton Group. A quick look at how we ended the day on Bay Street and Wall Street. The TSX Composite reaching another record high, pushing above 33,000 for the first time, ending up the day 112 points, up 0.3%. The S&P 500 gaining today just 17 points, and the Nasdaq a gain of 58 points, about 0.25%, taking it to 23,530. Thanks for joining us today on The Close. We'll see you back here again tomorrow.